Indeed, it first started with the Ghana Cedi. It was some sustained stability, and then we saw a record appreciation against the US dollar. We also saw the GDP expanding significantly in the first quarter of this year. Then we also heard about Fitch rating saying that based on the conclusion of discussions or reaching more of a great improvement to their creditors, they are reviewing our credit rating status to a B- with a stable outlook. But with all these things, is it true that the economy is recovering or not? We've heard from the politicians, the analysts, but I also hear from the businesses in terms of their reaction to it. We had the Fiscal Service also released their PPI, Producer Price Index, that suggested that in terms of the industry cost, it is going down. So is the economy recovering with all this data? And what are the businesses saying? If indeed their cost input is going down, why are they not passing it on to us consumers? Are they always trying to shift the goalposts or not? We're looking at the Ghana's recovery of the economy and businesses. In studio, I'll be joined by the Chief Executive of the Ghana National Chamber of Commerce and Industry, Mark Abuaji. He's here with me in studio here doing some analysis also. Sayo Alate's partner at accounting firm Deloitte, and also on Zoom, be engaging the thoughts of an economist as well. I should talk about the economy, businesses, fundamentals, recovery or not. All these issues wrapped up on PM Express Business Edition. We'll be right back after this break. Welcome back to PM Express Business Edition. Let's run some numbers by you. Let's first start with Fitch, or the rating agency, in terms of what they've done to, or the verdict that they presented on our economy when it comes to government's creditworthiness or the country's creditworthiness. You saw that they've actually done an upgrade from the restricted default to the B- in terms of their verdict on government's ability to settle its debt. And what we understand was that it is because of the debt restructuring program that we are almost through. So they think that we are less risky, and just some understanding that because we are playing in the capital market, we have to subject ourselves to review by these international rating agencies. So you see the grade where we have come from in terms of the restricted default, from that is the C, CC, CCC, and then the B-. So you could see the numbers over there in terms of the years and all those things. By Fitch, our ratings from Ghana declined. The debt levels, sustainability build-up in international reserves, debt restructuring near completion, and also inflation is to decline. And those are the factors that Fitch has actually outlined for us. If you look at the inflation numbers in 2022, where the inflation was, and now where is inflation right now, our gross international reserves as well, you could see that significant jump. And also the debt to GDP ratio as well. Let's see, and some are saying that it could even go down further in terms of looking at the way things are happening. Recently, the president talked about the fact that we could be saving about 150 billion Ghana cedis because of the city's sharp appreciation against the US dollar. So let's look at our external reserves, our financing, that is before and after the debt restructuring, how things will actually pan out, the pre-restructuring and actually the post-restructuring. You could see the numbers on your screen there in 2023, and even fast forward to 2026 and how things would actually look like. So you could look at all the three agencies where we were before. Well, let's start with Fitch. You could look at where we were as in the restricted default, and now we are classified as a B-. Go to Standard & Poor's, we also selected default, and now we're having a CCC+, and also Moody's as well, where we were before and where we are right now. And all this discussion is basically had to do with the fact that whether the economy is recovering and what do businesses have to say about it. We've seen what the former Minister of Finance had to say, his argument about whether the rating agencies are giving us a good deal or not actually. And also this is what the president has commented. So capital market, IMF projections in terms of return date, they're looking at somewhere around 2020 in terms of when we can go to the market and when we are likely, or the amount that we can actually raise. You can see the numbers on your screen there. So let's bring in and also look at the question about the producer price index as well. And that is, we were having some off-record discussions in the studio here. So you could look at it. April, it was somewhere around 18.5, and in May it's got into 10.25. And my economists in the studio will help me in terms of my layman understanding in terms of the cost input of manufacturing firms and industries. And you can look at just on year, it's done more than 8% decline. If you do that month on month, there was some deflation over there as well. And one would ask that all these numbers, why are we not seeing it on the market as a consumer or maybe as an individual if you walk into the market as well? If you look at the GDP numbers as well, and there's the difference over there. Look at the GDP numbers as well. The Ghana Fiscal Service will also tell you that we have seen some significant growth for the first quarter of this year, looking at 5.3, the drivers this time being agriculture, crop production. So that is what the data is telling us as to whether the economy is indeed recovering or not, whether we are out of the woods or not, or indeed we have a long way to go. Let me start first with the Chief Executive of the Ghana National, that is the National Chamber of Commerce and Industry, So I want to start first with the PPI. Yeah. I'll hold the Cedi constant. If you see that your cost input is going down, why are you not passing on to us? And some manufacturing firms are asking for a 60-day cycle, a 30-day cycle, a 100-day cycle. Some are saying that most of the Ghanaian industries and firms are not being fair to consumers.
So if what the PPI is portraying to us is that on average, the prices at the factory gate, the prices that producers of goods and services are receiving at the factory gate has gone down by over 8%, which means that obviously the cost of production has also gone down. Yeah. The difference between the PPI and the CPI is when you factor in taxes, you factor in cost of transportation, the intermediary costs. So what gets to you actually includes all these externalities, the taxes that we know, there are so many. But the PPI had gone down, which means that the prices at which the producers are giving to the people who are selling at the market had also gone down. So it means there is a positive sign there. There's also a positive relationship between the PPI and the CPI. Anytime the PPI goes down, the CPI automatically will also go down because the price at which those intermediaries are taken from the factories had gone down. So add taxes, add cost of transportation, your final price to consumer will also go down. So obviously, the producers are passing on this positive sign. They are passing on the reduction in the cost of production to the consumers. If you look at the inflation itself, at the last count, it was 18.4. But look at inflation for the locally manufactured goods. It was higher than the average, that is 19.2, which means that the cost of production locally had not gone down. So for a manufacturing company to reduce its price on average from last year to this year, to compare the months last year and this year by 8.3, for me it's a positive sign. It may take some time, obviously. Once the PPI goes down, what gets to you finally will also go down. If government decides that the taxes that we are paying, I'm going to do something about it. And also, obviously, the cost of transportation is going down because we are all benefiting from the appreciation of the Cedi, which translated into lower prices at the pumps, which means that the cost of transporting goods from one point to another will go down. Once we see all these positive signs feeding into the CPI, the price that you are paying at the market will obviously go down.
I mean, I took the Cedi away in this whole variation, whether I'm being fair with my analysis or not. If you factor in the Cedi as well now, why are we not seeing some significant reduction in prices at the market as well?
So let's look at it this way. There are people who are importing and selling directly. There will be a positive and instant, obviously, response from the appreciation of of the cedi, because initially I needed more cedis to buy dollar to be able to import. Now I need less cedis to buy dollar to import. So my cost of import will go down. And if you look at those that are selling imported goods, you will see that prices had gone down. But the goods that are manufactured locally, if the person is importing raw material, obviously the effect will be there. But the local cost of production, my brother, is still very high. For businesses, these macroeconomic indicators, they are not an end in itself. They are means to an end. So when you see the cedi appreciating, when you see inflation coming down, for us, we want to see how it translates into a lower cost of production. If the inflation is coming down, obviously, the central bank should also respond by reducing their policy rate. Interest rate will come down. If you have a policy rate of 28%, in spite of the appreciation of the cedi, in spite of the inflation coming down, then the person who goes to the bank to borrow is borrowing above the 28%. The cedi is appreciating. It's not affecting interest rate, so you don't expect that the person will reduce its price because the cedi has appreciated. So the dynamics are more complex than what you see. But if all these things will translate into a lower cost of production, now we are expecting that at the next quarter review of utilities, the appreciation of the cedi and also the depreciation will translate into a lower utility tariffs. But that is what they use in calculating the utility tariffs quarterly review. If the utility tariffs remain as high as it is, in spite of this benefit we are getting, then you don't expect that a manufacturing company who is using electricity and just last 2 months, it has been increased by 14-point-something%. Water has gone down because the cedi is appreciating. It means the person will have to reduce its prices. There will be some level of reduction, but it will not be significant. That portion of the reduction will reflect the appreciation of the cedi, but the other cost of production, which is high utility tariffs, water, the taxes, if they are not affected by these macroeconomic indicators, then the prices will not reduce significantly.
Mr. But
if you go to the market,
yeah,
you see some signs of obviously a reduction in prices. I was happy when I heard one of the airlines have reduced its price by 10%. Recently, I also got some information about iron rods going down slightly, and other products as well. The issue has to be how sustainable and consistent these indicators will be. Once we get to that level, all of us...
Mr. Boaja, for the person on the street who doesn't appreciate some of these economics that you're explaining to us, and they say that industries are just shifting the goalposts, because if I take, for instance, I walked into a shop, and I won't mention it because of advertising for them, and the same product that they were importing from outside had seen almost about a 20% reduction. I walked into a same Ghanaian-owned supermarket, the same product that was imported, and the price was still the same. When I questioned that owner, oh, you know, I bought it at a very expensive price, I have to do all those things. There's this argument that industries, some of your members, are just shifting the goalposts when it comes to these economic indicators and whether it's impacting on your operations or not.
No, you see, that's why competition is very important. What we are suffering from as an emerging economy is lack of information. If you have information about these two shops you are talking about, you are supposed to drive demand to the one that has reduced its price. That is obvious. So if a company, for instance, has imported in recent times using the appreciated cedi, then obviously that company is supposed to reduce its prices. Others have, advanced an argument that they have stocks that they have bought for 3-4 months. Those stocks are still there. If they are able to dispose of those stocks and they are getting new stocks, obviously they'll have no option than to reduce it. But if you stick to the same price by benefiting from the appreciation of the cedi, then you are not being fair to consumers. So if information is available for us to know that for this particular product A, I can get it from shop A at this lower price and then shop B at this higher price, people will move to that higher price. So the lack of information is also not helping us. So people walk to a shop, they don't have information of prices elsewhere, so they just buy. But our appeal, to all those who are selling, that if for any other reason they have benefited from this appreciation and they have imported anything at a lower price, I think they should pass on this benefit.
You represent the Ghana National Chamber of Commerce and Industry, and I know that even if it's not an annual meeting, there are WhatsApp engagement, informal engagement. For the majority of your members, what are they telling you that when are we going to see that significant reduction in all this cost savings being passed on to? Are you still also working with other associations that have given us a 90-day cycle and all the rest?
Yes.
All that things being equal, when are we going to see your members telling that, okay, Mark, I think that I've been able to balance things out for your informal, not mentioning names, they're telling that, okay, from July going, if these indicators still remain the same, July 1, we are going to see that significant reduction in prices of goods and services?
I think now, since we started experiencing this appreciation, most of them who have had their stocks have, disposed majority of them. Some are now ordering new ones. So obviously, I think that giving ourselves 2 months, the worst significant is what I...
2 months, so 2 months starting from July 1?
Or from July, we are likely to see if, things remain the way they are, but obviously we are seeing some stability. That is good. We are likely to see a reduction in prices. But the use of the word significant is something that we should be a bit cautious about. What is the measurement of significant? Aside the appreciation and their importing, as I told you earlier, all the other costs remain the same. So we are expecting that at least there will be some form of a reduction. If you say significant, then you are asking people that when they go, the thing is 10 cedis, they are supposed to see maybe 3 or 4 cedis. That is significant, but it may not be like that. But they are likely to see a reduction.
And that's what you hear from your members.
Yes, that's what our members.
I'll be bringing in an economist, Professor Patrick Esumi, very soon. But you play in the financial space. Are these numbers real? When I see that GDP, the economy is expanding, when I see Fitch saying that your sovereign is good. We are also in finance that you can never get a better rate than your sovereign, even though in the past, Cocoa Board used to have a good rate compared to the country. What is happening in the financial space? You engage businesses. Whether all these things, if they are real and they are impacting on the operations?
Yeah, so thank you very much. So I think we should put what's happening in the context of some of the reports that we've seen, particularly Fitch rating recently and a few other reports that we've seen. So a lot of the indicators from Fitch, their recent rating is driven by factors such as our normalization of our relations with our external creditors. So historically, we had this challenge of taking a long time to restructure our debt, some of the creditors were struggling to ratify. We've gotten to a point where about $5.1 billion have been ratified by the external creditors, but another 2.7 yet to be ratified. But I think that normalization of external creditor relationship is very important because it increased the confidence in the sector. Last year, our economy grew by about 5.7% GDP growth. That's a significant growth. And I see that in the budget, we are even estimated to grow at 4% in 2025. I think that is even maybe it's just moderate growth. I think it's something we can achieve because if you've grown in the previous year by 5.7 and you are projected to grow at 4%, I think we can achieve that. Going forward, if you look at some of these indicators, and I like the question you asked, how are we performing compared to our peers? With the exception of maybe Nigeria, which is at 22% inflation, Ghana is at 18.4%. Kenya is at 3.8% inflation. They have achieved the single digits, and they've actually go below 5%. South Africa is at 2.8%. So the question you are asking is, how real are these figures? If we are comparing our peers, we have moved from significant room for improvement to more room for improvement. We still need more room for improvement. And maybe to answer some of the questions around why we are not seeing the effect in prices. Yeah. The first one is the price stickiness. The popular rule in economics is that wages are rigid downwards and flexible upwards. A lot of business owners want to be certain about the trend they are seeing. Remember, our local currency only appreciated by 30% in the last couple of weeks or even the last month.
You did more than 40%.
We started the year somewhere around 14 to dollar, and then a significant decline in where we are. So in the last 6 months, same for inflation. Inflation ended the year at about 24%. Today we are at 18%. So in the last 6 months, 6 percentage point reduction in inflation. So for business owners, until they are certain that this stability is something that's going to be sustained over a certain period, they are quite hesitant in reducing their price. The second point is what was made earlier about long-term contracts. For someone who has locked up a contract with the importer from China, within the 3 months period, until the person has cleared the goods and then gotten it delivered, the person cannot change the price at which he locked it. So a lot of our clients that we talked to, he said, I imported at 15. I've imported and locked the contract at 15 to $1. If I bring the goods in, you can't tell me to sell that good at a price that will put me in a disadvantageous position. So that's something that we know. And then the last one, the cost structure. If your local production, significant portion of it is not denominated in foreign currency, but in local currency, significant part of them being tariff, for instance, utilities. In the last couple of weeks, you've not seen utility price going down because the local currency has appreciated. No. So if that cost is still there or is still increasing, you may take your time before you reduce the price. Also, labor. Cost of labor, nobody has gone for a reduction in salary because the local currency has appreciated.
I think someone told that don't go there.
Cost of labor still remains the same, and in some situations, people have been asking for higher wages. So if the person's cost, driven by utility, cost of labor, and locally produced goods are increasing or staying the same, then you will not see the effect on the price. And I think overall, what we need to do is to just wait for the gestation period. The gestation period is a period of 3 to 6 months, where we have the inventory cycle. For goods and services, and particularly for goods, the inventory cycle has to be completed. And the completion of the inventory cycle is between 3 to 6 months. That's when we see the impact. There are others that can see immediate impact. For those who are importing and getting them through, let's say, real-time delivery, through the airline system, the person orders today and then next week he receives the goods. Those ones, you can see the impact. Let me give you an overview of the inflation effects last month, as was reported. So which of the 5 sectors saw reduction in inflation or in cost over a period? So recreation and sports and culture was 22.5% reduction, followed by alcoholic beverages and narcotics and tobacco at 22.4%. Housing, water, and utilities at 21% reduction, followed by clothing and footwear at 19.3%. And lastly, personal care, social protection, and miscellaneous goods. So if the things you buy are clothing, footwear, personal care, and miscellaneous goods, those goods you will not immediately see the impact because they are slow. But if you fall in the category of alcoholic beverages, narcotics, you will see the impact immediately. If you fall in the category of recreation and sport, you will see the impact immediately. So it depends on what your consumption is.
What you are buying, your basket of
what you are buying.
Let me bring in an economist, Professor Patrick Sumin. I mean, we've always known in economics about macro and micro. If I look at these numbers, am I right to make a judgment that the economy is recovering?
Well, good evening, George, and good evening to viewers and to my co-panelists in the studio. Thanks for having me. Before I address that, I wanted to clarify something with the PPI numbers that we've seen.
Okay.
Because I think we have moved from around 18 to around 10. That's about 8 percentage points drop. But we still have to understand that prices at the wholesale prices are still rising. They haven't declined.
Okay.
So I think we have to understand that there is a rate of price increase that has reduced. So, and then I think as you has pointed out, we have to understand that yes, the currency has gained and strengthened, but the other components that go into production, we've seen in this period, utility tariffs keep going up, and it's a big element of the cost. And then we also see wages are not coming down. And, domestic cost of production in the country is rising. So I think when you put all of that together, we begin to see why perhaps prices are not going to, we shouldn't expect that the decline in inflation means that, prices are coming down anytime soon. But I think to your broader question, I think we have to understand it from the point of view of where we were and where we have moved to. If you look at how the economy ended in 2024, and even if you stretch back where we have been, our macroeconomic indicators are looking way much better than where we were before. So I think that we have to be clear. It seems to me that the financial and the monetary side of the economy has performed better, and the real side seems to be lagging behind. So you see that government has been very quick to try and put its finances in order, and that has reflected in the T-bill rate. And then because a combination of some policy direction in terms of our reserve position, as well as some lack in terms of what has happened with global prices of some of our export items, we have done well. So that has also boosted our foreign reserve position. And then, I think the fact that we've decided to kind of cash in on some of those reserve positions, it has helped. And then we've seen, because of that, we've seen the indicators improve. But we still have to understand that even though the first quarter GDP outperformed expectation, there are still lingering weaknesses. If you break down the numbers, you begin to see the economy is divided into 20 subsectors. Now, it turns out that 5 subsectors saw a decline, but the weightier subsectors grew strongly. So I think it kind of made up, and therefore we are beginning to see, we saw a stronger growth. But I think in the main, we have to see that the financial side of the economy and the financial indicators are moving forward much better than the real side. And I think that tends to give you some disconnect between how people are perceiving how the real side of the economy is doing and or the macro numbers that they see and how they might be feeling in terms of their pocket. Of course, as for the Cedi appreciation, its impact is more immediate because you see that its impact on fuel prices is more immediate. If you look at the pricing window we use for fuel, every 2 weeks, so it means that the prices move quicker there. But if you look at its transmission through the other parts of the economy, it tends to be a little slow. So we see fuel prices will move faster. Even transport fares will move slowly because of the pricing mechanism we have adopted, that even before the prices are changed, there has to be some discussion between government and the trade union, the transport unions. So all of those ensures that some of the effects of that Cedi appreciation takes time for us to see in the full side of the real side of the economy. And I think that's what we are seeing. But overall, you can't debate that the indicators are moving strongly in the right direction. And but I think more reforms are needed to strengthen the real sector so that the gains become more sustainable.
So, Prof, I was asking earlier, can we make that intelligent guess that we are recovering or we are on that path to recovery? Because the argument too is that if you don't get this thing right, it has some false sense that puts managers of the economy and even those who are supposed to do more to get us there.
There's definitely some recovery momentum building. If you look at the broad range of macroeconomic indicators that are seeing, you see sustained improvement over at least half a year, it's fair to say that some recovery is taking place. But we have to look at what we have done that has brought the recovery and whether it's sustainable for us to continue on that path. I already mentioned what we've done with government finances. The 2025 budget that we put there is really steep in terms of fiscal consolidation. And you see that because of that, the government has been slow in terms of implementing some of the main programs that it proposed in the lead up to the election. You would not expect that the government will be able to implement such a budget going forward. So I think while restraining expenditure. The expenditure management that is done is great. We are going to have to improve the reforms on the revenue side, especially the tax. And we've been told that there's a major reform of VAT coming up. We are waiting to see what that will be inside, what that will bring us, and whether from that end we will be able to say we are going to expand the revenue envelope to the extent that the deficit going forward is going to be kept under control. Then we begin to believe that the structural changes that are required to fiscal side has been implemented. But all of these will have to be translated into making real sector reforms. The government has said they are going to do export diversification. There's still agricultural modernization. All of those elements, we are not seeing much yet. And of course, it's not a criticism. You know, you start to put your finances in order, then you begin to, once you're on a strong footing and then you get some fiscal space, you begin to move from there to implement sustainable real sector policies. But we need to begin to see those ones, and then we can be fairly convinced that this recovery that we are on will be sustainable.
Prof, I'll be coming back to you a bit about what should government be doing and also the real threat side. But Magwedua Boaje, I mean, we are accusing you of not doing much, but are your members, commerce, industry, are you also feeling the impact of some of these indicators when it comes to cost of credit as well? When it comes to now, because of what is happening, your creditors are now more willing now to give you a favorable credit terms and all the rest. So, or we are not seeing that transmission mechanism also work for your members when it comes to cost of credit and other indicators that's supposed to aid in your operations?
The transmission mechanism has been extremely very slow because cost of credit, as you refer to, will largely depend on the policy rate. And of course, it's a derived, what we call a derived rate. So if you have inflation coming down, Cedi appreciating, but it's not translating into a reduction in policy rate, the banks will also not respond by giving you a lower cost of credit. So largely, cost of credit is almost the same. We've seen a bit of reduction, but it's not substantial enough for anybody to say that it's going to transmit into a lower prices. We've also made mention of tariffs. Nothing has changed. It remains the same until they do a review and say the electricity will go down by such a percentage. Then obviously...
Are you looking forward to a tariff review as in a reduction?
No, it's called tariff.
No, yeah, I'm saying that, but are you looking forward
yes,
to...
Obviously.
Really, if you look at the indicators?
Obviously, the indicators are pointing to the fact that...
But is that going to happen?
It should happen. Because when the Cedi is depreciating, inflation was going up, what they use in calculating the tariffs were basically these two factors. So they will say, we have seen the Cedi depreciated by such a margin, is 1 Cedi to 16. Inflation is that high. So tariffs is going to this level. Now you've seen a reverse. Just as you are asking businesses to reduce prices because the Cedi has appreciated, they should also respond positively by also reducing the tariffs because the Cedi has appreciated by about 40%. You've seen a drastic reduction in inflation. So if these are the factors you use in calculating your tariffs, there shouldn't be any reason why you should keep your tariff that high. Just as you're asking, they should also respond. If the central bank uses the foreign exchange, they use inflation to determine what the policy rate is. And we've seen a reduction in inflation. We've seen the Cedi appreciating. What then prevent them? I mean, they've made mention of the fact that they are still upside risk. They want to consolidate before they reduce the policy rate. If you read the Fitch report, they have also proposed, just as we are saying, that we should see a reduction in the policy rate in the next MPC meeting in July. Yeah. So obviously, the indicators are all pointing to the right direction. And as I said, these indicators, they are not an end in themselves. They are means to an end for businesses. When they translate into a lower cost of production, when they translate into a lower policy rate and credit, cost of credit, into a lower utility tariffs, into a lower cost of transport, then obviously this will also translate into a lower cost of production, and you are going to get a lower prices for your goods and services. So we have a responsibility as businesses. The government, who is the policy implementer and also the maker of policies, they also have a responsibility both from the fiscal and the monetary side. I'm happy because I've seen a good relationship now, a complementary relationship between the monetary and fiscal policy. This is something that we asked for in the previous government, that you see the fiscal policy being somewhere, monetary policy somewhere. You can't control inflation largely by using monetary policy. And it was obvious from the way they were increasing the monetary policy. Inflation was still going up because the fiscal side was also not helping, was not supporting. So you see taxes, you see higher cost of production. But now they seem to be working together. I would ask that and plead that they should work as good as they are doing now. If they do that sustainably, consistently for a longer period of time, the effect will be positive for the country, for businesses, and also for consumers. So we want to see that these indicators are translated into lower cost of production, and all of us will enjoy. Mind you, the business person is also a consumer of a product.
Okay.
If you are selling a phone, all the other things, you don't have them, you consume. So if you want to keep your price that high, that person will also keep the price high. And in the end, none of us will benefit. So it's something that all of us will have to work together. The government should play its part, and I assure you that the business community will also.
I asked the question about the tariffs because now that the 1 Cedi energy sector levy has been suspended, we don't know where it would end up to. And also, prior 2 months to this tariff thing, under the IMF program, there were proposals that we have to ramp up tariffs to make up for the debt. And that's why I'm holding all these variable constants, and I still want to come back to that. When you look at all these things, is this something that it's a no excuse for PRC not to drive the tariffs down?
No, it's a no excuse. You know why? The cost per kilowatt hour for electricity for a manufacturing company in Ghana is among the highest. For a typical manufacturing company, electricity cost alone is about 30%. And you want the businesses to produce and sell at a lower price. Of all these benefits, if you keep tariffs very high, obviously you are keeping the cost of production also very high. So just as we are asking, they should also play their part. If it's not working within the utility, within the fuel, just as we are saying, why push it to the utility sector? I mean, we are not helping.
There's a cost that we have to deal with now. And then the Minister of Finance is saying that he has to find a way to balance his budget because the cost of liquefied or liquid fuel for the power plant is throwing his budget out of gear.
So the intention for me, the intention for the 1 Cedi that they were planning to introduce is very, very good because we don't want doomsaw, and it's been dubbed as a doomsaw levy. But from our point of view, we think that the consultation was not well done. We think that the rate was very high. You are putting 1 Cedi per litre. Start from somewhere, and then you move on. You observe the market because we have just started enjoying all this Cedi appreciation. You've just started enjoying these lower prices at the filling station, and then you want to increase it. And you know, these fuel prices, we don't have control over. I mean, probably that was the main reason why there was no sunset clause. Also, one of our concerns was there was no sunset clause in that particular levy that they were introducing. Just within a week, look at what is happening. So if they had introduced the 1 Cedi, and with these fuel prices, crude prices going up, obviously we'll go back to where we were. What benefit would you have created for citizens? Let us enjoy ourselves a bit. You want a lower price, give the businesses the opportunity to transfer this lower price to the typical citizen by also reducing their cost of production. So I'm happy that they have suspended it, and I'll be happier if they don't bring it back. Because
there's an energy sector debt you have to finance. There is a buying more fuel that we have to finance.
Energy sector debt we are talking about. The question we have to ask ourselves is, the debt is coming from where? Now, who costs them? If ECG have to do more, let us support them. I've seen what they are doing. Now they have disconnected government agencies. If you're a citizen, you come to my house, I'm owing you just 500 cedis, and you disconnect. 200 cedis, sometimes 50 cedis.
Yes.
And they disconnect with some level of anger. If you're not careful, they will beat you on top. Yeah. But you have a government who owns 10 million Ghana cedis, 20 million Ghana cedis, and they keep on piling this cost. And you want to pass it on to consumers. Also, the ECG, the level of efficiency there is questionable. Why don't we help them to improve on these things? Otherwise, we will end up always paying some level of levy or taxes to support these businesses or these government agencies that are not doing well. That won't help us in the long run. Let us help them, find a better way to help them. And not always, because they also know that even if we don't perform and we have this huge debt, there are people who we can pass it on to, and they will pay. When they know that you have to work to pay yourself, you have to work to pay for your debt, they will know what to do. Don't let us pamper them by saying that anytime we have huge debt, we need to pass it on, get a tax and pass it on to. Who is paying the tax? It's the citizens. So,
Mr. Lati, let me come to cost of credit. And Dr. Bajim made a very, very important point there. Why are we not seeing what has happened at the macro level also impact on cost of credit? And you work in the financial space and all that. I mean, why that one? And second also, is the inflation or is the policy rate a main indicator here? If I know that Mr. Magbedua is credit worthy, and I know that the environment is improving, he can quickly turn around the money and pay me back on time. Shouldn't that be able to impact whatever engagement I have with him when it comes to credit extension and all those things? What is happening? What is the financial book saying, and what are you also getting on ground?
Yes. So I think we should look at the factors that drive the cost of credit in the country. So the first one is the reference rate, which is the monetary policy rate. It's a reference rate, but it's not a key driver of cost of credit. And so if historically government position or the central bank position has been to maintain a policy rate or keep it at a certain level, which will support investment in the sector, then obviously cost of credit will not come down significantly because the policy rate has not been reduced significantly. If it's been slow in coming down, then cost of credit will also be slow in coming down. The other driver of cost of credit, it's also on the other side, where what is the, let's say, the opportunity cost. If I don't give money to someone out there, I give it to government. Historically, government TB rates were very high. If government TB rates are high, banks are incentivized to give the money to government and not give to other, because government is less risky compared to third parties. Now, the good news is government or returns on government securities are going down. So there should be incentives to give to that, but there are risks in the numbers.
And are your numbers telling that, are they shifting to some Bedouin members, or they are doing something else?
There's been some improvement, because if you look at the DOG reports, financial stability report, there's been some improvement. So credit to private sector and to business are increasing, whereas historically it was to government. Now we are seeing some significant improvements in advance to credit or advances to private sector. I think what we need to do is to ensure that what we are seeing in returns on government securities going down, cost of credit should also go down. Now, a lot of banks that historically never used to give credit are now chasing business to give out at 20, 21%, sometimes even at less than 21%. Whereas in the past, it was over 30%. That means that the drivers of cost, which was government security, has gone down significantly. So cost of credit is also going down. We expect this to go down significantly because if you look at our peers within the Africa region, cost of credit is somewhere in the 10%, 20, 15%, somewhere less than that. And so if we are talking about 30%, we were not really in a competition at all. And if you want to drive things like AFTA, we are not benefiting from AFTA because other countries are advancing better credit, cheaper credit to their businesses and supporting their business to export. Someone in Ghana is borrowing at 30%, whereas someone in Ivory Coast is borrowing at 12%. We are not in the same game. Also, the other factor is competition. If among the banks themselves, they are competing, just like even the telecom sector, you see a lot of competition. You see that will also drive down credit. Because we run credit competition for our clients. So if a client is looking for money, we go to market, we reach out to all the banks, even development banks. We ask them to submit term sheets. And you can see that someone will come as low as 12% or even 9% dollar facility. And another person will call you, I'm ready to match it. I'm like, oh, really? You came in at 15% and you are ready to match 9%. It means you are capable of doing 9%. It's just that if there's no competition, the guy will still be running at the 30% or even 9% on the dollar. So if we create the right environment, commercial banks will be competing against each other. And I see that happening a lot. The GR rate for different banks and various banks are changing. So for some, they are 22%. The next day, they hear somebody at 18% or even 15%, they will reduce it. So I think we should encourage that competition, and we should also see the policy rate coming down. Because
but now looking at what is happening, we'll come to those discussions, what is happening in the Middle East and oil prices. Any conservative economist or monetary economist person would again want to hold the policy rate constant at worst or even a hike again. I know Magbedu would disagree with me. Is it not good to be, and let me come to you first, is it not good to be more cautious than to be overtaken by events?
You see, the management of this policy rate, for me, I've always had issues with it.
But doesn't Bank of Ghana being vindicated by a lot of things that have happened over the past 3 months or 6 months, I would say?
For the policy rate, that they are keeping at 28%.
Yeah.
You see, the prof rightly said that at the financial side we are doing, at the real sector, we are not doing well. If you consistently want to keep your policy rate that high. Now, inflation is 18.4 or so. Your policy rate is 28. So the real interest rate is over 10%. You understand? And at the times where inflation was high, the argument is that the real interest rate was negative. That is why we are keeping the policy rate high. So now all the dynamics are pointing to the fact that it is about time they reduce the policy rate. It's a signal rate. So we are not saying they should reduce it by 10%. They will be cautious. But they have to reduce it and also send a signal to the market that we are reducing it. Follow suit and reduce it. It's a process. Once we see that it comes down, and I have said that in July, the MPC, the policy rate should be reduced more than 3%.
Oh.
Yes. And that would be a good signal.
If I'm a member of the MPC committee, and again, looking at what is happening outside, I will hold the rate at 28%. Yes, I'll vote for it to be kept up.
Then I don't think that you also have the moral right to come and ask a business person or a business owner.
What do you think? I'll come to the economists as well. The argument about the policy rate and whether it should go down to improve credit extension.
Yeah, so I think
at the next meeting, should it go down?
Yeah, so in the last few years, you realize that inflation was higher, and so what we were trying to use the policy rate to drive us to ensure that people do not get negative return on their investment. Now, the trend has reversed. So if inflation is at 18%, the policy rate can still come down further. But as you said, there are some risk in the numbers. What is happening in the Middle East is likely to affect oil prices. And given our situation as a country and how much we import, especially our reliance on oil, we are likely to fall in a situation where we found ourselves when we had Russia-Ukraine war. Because we rely a lot on imports. And if we rely a lot on imports, what happens at the external level? But I think we, just to add to what was said, we have some benefit that we are getting. Commodity prices are increasing significantly. Gold prices have more than doubled in the last 2 years. It was trading at about 1,700, now at 3,400. Cocoa price is the same thing. So we are going to benefit from these commodity prices increasing. Same thing with oil. So if we are increasing our production at Jubilee Field, we are exporting more gold and we are exporting more cocoa. We should have this benefit. And that should be used to offset other...
So if we were members on the, external members on the Monetary Policy Committee, you vote for a reduction, you vote for a reduction. I'll vote for keeping the rates.
Of not less than
I'll vote for
3%.
keeping the policy rate at still 20. Let me bring in Professor Patrick Sumi as well. Prof, in all of these things, have we all forgotten about the IMF program and what it's also done to this economy?
Well, I don't necessarily think you've forgotten about that, but I think it's an interesting debate on the policy rate and its impact. Unfortunately, for Mr. Bedua Budget, I don't see the policy rate coming down at the next meeting at all.
I think so.
I think that, yes, it's true that the inflation rate has come down, but we always have to understand that we are still very far away from our medium-term target of 6 to 10%. And while we are heading towards the right direction, I think and you have to look at the posturing of the central bank. I think they seem to take the price stability issue much more seriously. So I think that it will be a surprise to see the policy rate come down even 100 basis points, never mind 300 basis points that he is thinking about. But I think we also have to understand that from the bank's point of view, we have to understand NPLs are still very high. In fact, if you look at this year, the 4 months of the year, the NPLs have actually inched up a little bit. So I think we have to look at it from both sides. While, businesses will want the banks to reduce the cost of credit, I think we help ourselves a lot if the NPLs are coming down. I think this is where it comes down to the real sector of the economy. Now, on your main question about whether we are forgetting the IMF, I think it's a good thing when the discussion is not about the IMF and we are now focusing on what we need to do as a country.
No, my question is in the context that, there have been some debate in certain quarters about who has done what and brought us here. But some are saying that it had to take an external program or body to force us to get where we are today. And therefore, in all of these discussions, whilst people fight for who should take the credit or not, some will also argue that if it hadn't been the IMF program, and I know some would disagree with me, we may have not gotten here.
No, you are right on the score that we wouldn't take the bitter pill on by ourselves if it wasn't the IMF program. We would dilly-dally and then, don't forget the debates in the lead up to we going to the last IMF program. There was an argument that we should not go to the IMF, and then we waited for things to get worse. So I think in the main, the IMF program is doing what it's supposed to do. Force government to, put its house in order, and then, force monetary authorities to streamline their policy making. And I think that's really, in the main, that's what is done. What I think should happen going forward, though, is make sure that we implement the deep-seated reforms that will ensure that the gains will last. It's not the first time we've gone to an IMF and we've seen some improvement in our macro indicators, but we always go back and mess up ourselves. So I think, seeing what we are seeing, that is not a big deal. I mean, it's a big deal, but it's not something you haven't seen before. Sustaining the gains and making sure that we don't need another IMF program in the next so many years is more important. And so I think that's where ensuring that we implement the structural reforms, improving expenditure controls, improving the revenue stream, and it's very important. But even beyond that, the structural changes to the economy, that has to follow. Because what the IMF program will do is to help us to stop the rot and then improve the environment. But if we improve the environment and we don't kick on and implement measures that will change how the economy is functioning, then obviously we are bound to go back. So I think implementing those structural reforms are extremely important.
Prof, just one quick one. There were some who argued that COVID exposed the weakness of this economy, and it shows that even though some would say that it destabilized us, we didn't really have those necessary shock absorbers. we have the Israel and Iran conflict that is going on. The governors argue that he thinks that this time we've learned our lessons and we wouldn't be that exposed. I mean, talking as an independent economist, do you think that we have built the required shock absorbers that this thing happening, if it doesn't end anytime soon, Donald Trump is saying that, well, he would take an action in 2 weeks. It looks like the two parties are not going to end anytime soon. Would this war and the ardent effect, you've seen freight charges going up and all the rest, so it's not even just about the fuel thing. Would it expose the Ghanaian economy again?
I think the Ghanaian economy remains extremely exposed to, to external events. The way our economy is structured, the fact that we are, if you look at open economies, where economists will usually look at the sum of your import and export as a ratio of your GDP. Ghana is one of the most open economies in the world. All countries considered. Ghana is one of the most open economies. And we are open not just in terms of trade in goods and services, we are also extremely open in terms of our financial exposure. I think that perhaps maybe the governor speaks in terms of how much reserves we have built. But look, those reserves only help if we face extreme shocks. Those reserves can hold the cedi up for only so long. Mm-hmm. So ultimately, until we begin to rethink about how we finance the economy and reduce the dependence on foreign financing, and also begin to ensure that certain critical things are produced locally, our exposures are still going to be there, and we'll still be susceptible to the shocks.
Isn't that worrying, Prof, for you? Because then there are some who are worried that here comes another COVID-19 shock to the economy.
I think it's worrying. It's worrying, especially if we begin to think that because we have built some stronger reserves than we've done in the past, we take that to mean we've learned our lessons and we've done what you're supposed to do. If we think like that, then we feel that we've arrived. Then there's not much for us to do. But that shouldn't be the case at all. I think that, we need to understand, that these things take time. We didn't get here in a decade. It is how we've run this economy over several decades and built extreme dependence on what happens in the rest of the world. And those things can only be rolled back gradually. But at least you want to see the strategies. You want to see the policymakers communicating that this is what we plan to do. So I think when I heard recently the discussions about whether we should return to the international capital market, I was just shaking my head in disbelief. At this stage, is this what we want to think about? Absolutely not. We want to think about, what has happened to us that caused, ordinary Ghanaians so much pain. I'm talking about domestic debt exchange. How we will rebuild an economy so that we don't go back there. So to be contemplating going to international capital markets is just not something that should be within our plan. We should be thinking about how we are going to reduce those dependence on a gradual basis, building our own domestic resources and using government finances or bringing more efficiency in government finances and using our local resources more efficiently to finance our development. I think that's what we should be thinking about, and that will help us to actually reduce the vulnerabilities.
But I'll come back to you on the bit about the sustainability and what government needs to do going forward as well. And I'll come back to you. Mark, you heard the bit about the policy rate issue. You heard the bit about the economy and the structure things, and maybe you may have to be careful how you count your eggs and the chickens and all those things. And that's something I'll be coming back to you to get your thought on. Saying that the economy, we've still not built the required shock absorbers, and whether that worries you. As well, I'll be coming to you as well from the economist thought that does also worry you that any little thing could throw us back to where we didn't want to be as an economy. This is PM Express Business Edition. Be right back after this break. This is PM Express Business Edition. Talk about the recovery of the Ghanaian economy and the impact on businesses. And before we went for that break, I was trying to get the thoughts of the Chief Executive of the Ghana National Chamber of Commerce and Industry. The warning by Professor Sumi is that be careful because your economy is so vulnerable. And I know you're expecting a lot, policy rate going down, the tariffs coming down. It appears that these things might not happen because of what is happening.
Obviously, our economy has always been vulnerable. I don't remember a period where we have built a very strong and resistant economy that are able to withstand external shocks. So anytime we have these shocks coming, you see all the indicators also, going to the other direction. And it's been one of my major concerns. We seem to depend so much on external factors, even in goods and services, even in the financial environment. If you are in an economy that imports almost everything, any shock that comes your way, you'll be affected. The oil part of it is going to affect us. But on the other hand, we also are exporters of oil. How do we balance it? Because much as the prices are going up and it's affecting us, we are also getting some revenue from the export. I've seen, obviously, maybe a reduction in our exports in terms of the oil that is going to affect us. So if you want to build a very resilient economy, the advantage we have from the production side is to ensure that the basic things that we import, at least we are able to produce and consume locally. If you are importing almost everything, then the least shock we are affected. It affects our exchange rate, affects inflation, affects almost everything. And I think that the private sector in Ghana, they have the capacity to produce and export. What has been the challenge is the fact that they are not competitive out there because of the high cost of production. In fact, even around us, everything that a business person can think of as a factor of production, the price is higher in Ghana than even the countries around us. Think about it. Mention them. Interest rates, mention them, utility tariffs, all those things. So sometimes it gets to us that what is it that we are not doing right? You want to build a stronger economy. The real sector should be one of your key focus. How do you support the real sector? That is something that we are not doing. Our financial sector is also vulnerable, that the least shock from outside, we are affected. Smaller countries are able to build some of these shocks. What do we have as buffers? Even with this oil, at a point in time, it was that low. We could have done something. Could we have some stock somewhere that for this period that we are having challenge with this war, within 3-4 months, can we sustain the price at that level? These are the questions we should be asking ourselves, that we should have that buffers supporting the real sector to produce the basic goods that we need.
Yeah, I'll come to you, but let me bring in Professor Sumi as well, as I try to wrap up and get his final thought as well. For you, what should government be doing now, to try and at least our West should be stabilizing? Because you mentioned the externalities and the vulnerability of our economy. What should they be doing right now? And for you, putting again on the economics hat, what is your biggest fear looking ahead in the crystal ball?
Well, I think the government has started extremely well. And, it has, we currently have, a lot of good sentiment from both consumers and even the businesses. It's very important that we build on this momentum and in particular, start doing the harder things that we have been reluctant to do. And especially in the year that we've managed to pass a very austere budget, I think we will help ourselves a lot with doing the tax reforms, especially the VAT reforms, very well, and expanding the revenue base. When we talk about dependence on foreign finance, and that's where we start from, generating local revenues. So there's generating local revenues and efficiently using the local revenues. Because I think even if you solve the revenue problem, and the leakages and the loopholes in public spending are not sealed, no amount of domestic revenue will help our cause. So I think that's very important. And then also, in terms of public spending, bringing more efficiency and making sure we are getting value for money. Every time, if you take our two leading parties, every time they are out of power, they're able to explain how we can do so much with the revenues how all the resources are available in this country. I believe them. I believe both of them. I think it's just that when it comes to, it appears that when we now have access to use the revenue, then we forget all the good things. So I think improving efficiency in public spending is very important. Then when you fix the fiscal side and you have some space, then it comes to strategy. I think we have to have a long-term strategy that we believe in. If we allow ourselves to be hoodwinked by the 4-year electoral cycle, and usually our government will have 2 years in which to do the things that it has to do for the national interest. The last 2 years before election is all about some other thing.
Okay.
So I think we should encourage the government to use the strong support base that it has built to start those reforms and stick to that path.
Okay.
Then I'm sure it will go some long way into building a more sustainable economy.
Mr. Lati, your final words. I mean, what do you want? You operate in the financial space. What do you want those who are managing the space to do for you as you try and wrap up also with your final thought as well?
I think the challenges we've had in the last couple of years are driven by about 4 or 5 key factors. So the first one is our fiscal challenges. We had widening budget deficits. So we were overspending, and year on year, the budget was widening. The second one was our low revenue base. We have to find ways of increasing our revenue base. The third is our debt levels, which God be so good, I was just saying, in the last couple of months or years, we've been able to restructure that debt. The last, particularly on the Cedi side, is speculative trading. And if we do not have policy measures and some of the government communication are not well managed, people will continue to engage in speculative trading. And all the gains we have had in the last few months will be eroded when we don't manage. I think one thing that I will advise government to do, we should have long-term planning objectives. Our political parties come to government and they do the firefighting approach. Our economy has been involved in firefighting. We don't run an economy using a firefighting approach. Short-term policies which are not linked to any policy program. I've spoken to guys at the National Development Planning Commission, and you realize that they have very good policies, but none of the political party programs or manifestos are just fit into the long-term policy. We should have a long-term policy program which are aimed at long-term initiatives like, let's say, import substitution. We talk about this, but in an economy where you've achieved some stability, we should have some long-term plans, and those long-term plans should be well implemented.
30 seconds, your final thoughts, your final words.
For the business community, we are patiently waiting to see how these recovery indicators will translate into a lower cost of production. That is where all of us will benefit. But let me quick to add that monetary policy alone, tightening it, will not solve our problems. They should look at how they can support the real sector by reducing the policy rate and sending a signal to the banks that it's about time they also lend to business community.
It looks like you're softening your stance on the policy rate reduction.
No, it's still very tough. We're actually going to write to the central bank
to reduce the policy.
They should.
Interesting. And let's see whether that wish or call will come to. But this has been PM Express Business Edition, engaging the Chief Executive of the Ghana National Chamber of Commerce and Industry, Mabedu Abuajinsi, you do with me. Also, Yolate, he's a partner at accounting and auditing firm Deloitte, and also on Zoom, Professor Esumi is an economist and a lecturer at the University of Ghana Business School. I know that debates will go on in your homes and in your offices about whether the economy is indeed recovering and whether it is impacting positively on businesses or not. This has been PM Express Business Edition. Have a great day.